Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through market weakness. I'm your lead analyst, and today, SHAK is in the forge. Now, they just put up what should be a great earnings report, but the market absolutely hammered it. And when I see that, it tells me one thing. There's a crack somewhere below the surface. So today, that's what we're going to do. We're going to stress test their entire structure, from the concrete foundation all the way up to the rafters, and figure out if this company is built of steel or if it's about to buckle. Let's get to work.
All right, so here's the big question, right? This is the central puzzle we have to solve. SHAK comes out, reports a solid quarter. They beat earnings. Now you got to understand, that's looking in the rearview mirror. It tells you what just happened. But the stock price? Man, that's the market looking straight ahead through the windshield, and it immediately got crushed. Believe me, a drop like that isn't just random noise, it's a huge signal. When the past and the future disagree this violently, it means Wall Street is looking right past that shiny new coat of paint, and they think they see cracks in the foundation. So our job today is to figure out if these are just hairline cracks, cosmetic stuff, or if the whole building is about to come down.
Okay, analysts, let's cut right to the chase. As the market skeptic, this single slide is pretty much my entire argument in a nutshell. So you look at the left side of the screen. That's the story the execs are spinning, right? Hey, we beat earnings, everything's great, it's a victory lap. But then you look at the right. Whoa, that's reality smacking you in the face. A 9% drop before the opening bell even rang. When you see a disconnect that big, it tells me the smart money just isn't buying what the company is selling. So I've got a simple question for you, analyst. Who's right? Are the investors just panicking, or is this happy-go-lucky story from the C-suite a complete work of fiction?
That is exactly the right question to be asking. And look, to get to the bottom of it, we've got to do what we always do here. We do the heavy lifting. You can't just look for cracks without understanding what's holding the building up in the first place. We have to build the bull case first. We're going to forge it straight from the raw numbers, because here we respect the data. So let's put the fear and the market noise aside for just a second and really dig into the engine of this company. And we're going to start with their top-line growth, which, frankly, is pretty hard to argue with.
Okay, so pillar number one of this whole bullish argument. It's pure, raw speed. Top-line velocity. Look at this number, 21.9% revenue growth, year over year in the fourth quarter. Now, you got to put that in perspective. The entire fast casual space, it's growing at what, 5, maybe 7%? SHAK is blowing that out of the water, posting almost 22% growth. That is a huge statement. And listen, that's no accident. It's not a fluke. It's the result of an aggressive game plan where they're going out there and they are grabbing market share. So what this number screams to me is that demand for what they're selling, it isn't just holding steady, it's actually picking up speed.
And look, this wasn't just some lucky quarter. It wasn't a one-hit wonder. Let's zoom out and look at the whole year. They stacked an extra $200 million onto their revenue in just 1 year. Think about that. That's not a temporary bump. That is real structural growth. So that powerful Q4 we just talked about, it wasn't some outlier. It was the exclamation point on a full year of really solid, really consistent growth. And let me tell you, this is the exact kind of growth, that velocity, that investors who are looking for big returns will hunt down. And they'll pay up for it, big time.
You've heard this saying, right? Revenue is vanity, profit is sanity. Well, this right here, this is the sanity check. Their adjusted EBITDA, which is basically a good look at their operational earnings, it jumped 20%. It's up to almost $210 million. Now, this is absolutely crucial because it proves that the profit is growing right alongside the sales. They're scaling up intelligently. This tells you they're not just, throwing discounts at people to buy revenue. They're not killing their margins just to make the top line look good. No, they are actually turning that growth into cold, hard cash flow. And that's the sign of a business that is disciplined. It's a well-oiled machine.
All right, so let's get even more granular. Let's look at the actual blueprint of this financial fortress they're building. System-wide sales, a massive $2.2 billion. And this is the one you always got to watch, same SHAK sales. This tells you how healthy their existing stores are, and they were up 2.3%. What that tells me is that their older, established restaurants are still squeezing out more and more productivity. And even better, their profit margin at the restaurant level, it expanded by 120 basis points. They're now at 22.6%. So they're making more money on every single burger and shake they sell, even with inflation breathing down their necks. Hold on. Analyst, let's pump the brakes a bit. 2.3% same SHAK sales? I mean, that's okay, I guess, but it's not exactly lighting the world on fire, is it? It's barely, and I mean barely, keeping pace with inflation. How are you not seeing that as a sign that their core business, the restaurants that are already open, are starting to slow down?
See, that's a fair point. but you're looking at it in a vacuum. You're missing the other half of the strategy. They're making up for that, let's call it modest growth in their old stores, with a really aggressive, and I mean really smart, expansion plan. They threw open the doors on 85 new Shacks last year. That's a company record. But here's the key part. You have to look at the mix. It's almost a 50-50 split. You've got 45 stores they own and operate themselves, pushing into new parts of the country, but then you've got 40 licensed stores. And you gotta understand, those licensed stores are a totally different animal. Somebody else puts up the money, somebody else takes on the risk. Shake Shack just collects a high-margin check. It's basically pure profit. So this isn't just growth for growth's sake. This is very calculated. It's high return, disciplined expansion.
And don't just take my word for it. Here's the architect of the whole plan, the CEO, Rob Lynch, and he's basically putting his stamp on everything we just said. He flat out called 2025 a transformative year. Look, when a CEO starts using phrases like laying a foundation for sustainable, profitable growth, you gotta know that's code. That's not just corporate speak. What he's really signaling to Wall Street is, hey, the years of spending big, of heavy investment, those are done. Now it's time to harvest the profits. So really, the whole bull case, everything we've just laid out, it boils down to believing in that promise, that the heavy lifting is done, the foundation is solid, and now they're ready to build something much, much bigger on top of it. And frankly, the numbers we just walked through, they seem to back him up.
Okay, enough. I've heard enough about the beautiful blueprints and the grand architecture. You've built a really nice bull case, analyst. I'll give you credit for that. But you know what they say? A fortress is only as strong as its weakest point. And that 9% nosedive in the stock, that tells me the market doesn't just see a weak wall. It sees a battering ram heading straight for it. So let's stop oohing and eyeing over the design and let's start doing what we're here to do. Let's stress test this thing. It's time to find the cracks.
And you know what? We don't even have to dig for them. This isn't me making stuff up. These are the cracks the company admits to, right in their own reports. They know these are vulnerabilities. Let's run through them. Number one, a concentrated supply chain. That's a fancy way of saying if one of their key suppliers goes down, they are in deep, deep trouble. It's a single point of failure. Number two, rising labor costs. This is a constant grinding pressure that never goes away, just squeezing those margins tighter and tighter. Three, competition. It is absolutely brutal out there. They're fighting everyone from other fast casual chains to quick service joints, even the grocery store. And number four, their heavy concentration in New York City. Yeah, it was their launch pad, but now it's a huge risk. If anything goes wrong in that one market, it hits them disproportionately hard. Any single one of these things could be the crack that brings the whole wall down.
And look, it's not just me being a skeptic. This is what the pros are saying. Count them, 6 Wall Street analysts who cover this stock have lowered their earnings estimates for the future. They've revised them downward. Let that sink in. Think about how wild that is. The company just came out and beat expectations for the quarter that just ended. But the very people whose job it is to predict the future are all saying, yeah, but it's about to get worse. They've seen all the same numbers you just laid out, analyst, and they are not convinced. They're betting against it. To me, that is a giant waving red flag.
And if you want to know why they're so pessimistic, well, here it is. This is the pressure gauge. These are the forces that are actively trying to tear this company's profits apart. First, beef. The cost of beef is up in the mid-teens percentage-wise. That's not a small number. That is the SHAK in their name, and the cost is just exploding. Then you pile on top of that the constant nagging inflation in what they pay their workers. And suddenly, every single little basis point of that beautiful profit margin you were so excited about, analyst, it's under attack. It's being squeezed from both sides. And this isn't some guess about the future. This is what is happening to them today, right now. It's a relentless attack on their profitability.
So this right here, this is what the whole bear case boils down to. Your entire bull thesis, analyst, depends on 2 things happening at once. They have to maintain their premium brand, and they have to keep expanding their profit margins. But I'm telling you, you can't do both of those things when your most important costs are on fire. So it puts them in a terrible position. Here's the question. Can they just raise their prices to cover these costs without chasing their customers away? Or are they stuck in this horrible squeeze where they have to make a choice? Do they start using cheaper ingredients and sacrifice their quality? Or do they just eat the costs and sacrifice their profits? There's no easy answer. And that 9% stock drop? That tells you exactly which way the market is betting they're going to go.
That is the perfect question, skeptic. You've hit the nail on the head. But here's the problem with your entire bear case. You're working off of old blueprints. You're analyzing the company as it was, not as it is. You're assuming management is just sitting there watching this happen. They're not. The reality is, this management team saw these same cracks forming a long time ago. And for the last year, they have been in the middle of a massive strategic overhaul. They call it the core SHAK pivot, and its entire purpose, its only purpose, is to re-engineer the business to fight back against every single pressure point you just mentioned. And this right here, this is their 6-point battle plan. And don't dismiss this as just some corporate jargon. This is a targeted counterattack. You talked about supply chain risk. Look at point 2, optimize restaurant and supply chain operations. That's a direct shot at the inflation problem. You're worried about costs? Point 4, build Shacks with best-in-class returns. That's their answer to managing capital. And point 5, accelerate the licensed business. That's the pivot toward that high-margin, easy money we talked about. So you see, this is not a team playing defense, just trying to survive. This is a team that is actively on offense, retrofitting the entire company to be stronger and more resilient.
And again, this isn't just talk. It's not just a plan on a slide. They are already executing. You want proof? Here's the first piece of hard evidence. In just 1 year, they have managed to cut the average cost of building a new Shake Shack by 20%. 20%! That is a huge, huge improvement in how efficiently they use their money. Think about what that means. It means every single dollar they spend on growth now works harder for them. It generates a higher return on invested capital, a higher ROIC, right from the moment they open the doors. They are literally re-engineering their growth engine to be not just bigger, but way more profitable.
At the same time, they're reinforcing their fortress walls on the customer side. Get this, a 50% increase in app downloads. And they're driving this with smart promotions that you can only get through the app. But listen, this is about so much more than just selling a few extra burgers this quarter. This is about owning the customer relationship. It's about getting valuable data on what people buy. It's about building the groundwork for a real loyalty program down the road. In today's world, this is how you build a digital moat around your brand. Okay, but are these people actually loyal? Or are they just a bunch of deal hunters who downloaded the app for a free burger and will delete it the second the discounts stop? Great question. And the answer is, they become loyal when the actual experience in the restaurant gets better. And guess what? It is. That's exactly what these numbers show. Now look, these aren't the big, flashy numbers that make the headlines. But this stuff, this is the nuts and bolts that hold the entire structure together. They've shaved wait times down to under 6 minutes. They've gotten their employees to stick around longer. Tenure is up almost 40%. Think about what that does to your training costs and your service quality. It's a direct counterpunch to that labor inflation we talked about. And kitchen upgrades have cut down on food complaints by over 20 percentage points. So what do you have? You have faster service, you have more experienced employees, and you have a better product. That is how you get those deal hunters to stick around. You give them an experience worth paying for. This is what operational excellence looks like when you stop talking about it and actually do it.
All right, so we've laid out the two sides of the story. We've forged that bull case, piece by piece, straight from the data. And we put it under pressure. We ran the stress test and found the exact cracks that have the market so spooked. So now it comes down to the final verdict. We have to decide what that 9% stock drop really is. Is it a massive buying opportunity in a great company that's getting stronger? Or is it a screaming warning sign that you're about to walk into a value trap? Okay, let's weigh it one last time. The bull case is strong, and it's built on hard numbers. We're talking nearly 22% revenue growth, profit margins that are getting wider, and a growth plan that's smarter and more efficient than ever before. The fundamental structure is getting stronger. But the bear case isn't about the structure, analyst. It's about the hurricane hitting it. You've got intense competition from all sides, you've got crushing inflation on their most important ingredients, and you've got a whole group of Wall Street pros shouting that the storm is only going to get worse. You can't ignore these outside pressures. They are real and they are severe. And that conflict brings us to the core of the issue, the synthesis. The reason you see a great quarter and a terrible stock reaction is because you are watching a company change its identity in real time. Shake Shack is in the middle of a massive transition. They are trying to evolve from being this, high-cost, almost cult-like brand into something totally different, a super disciplined, highly efficient, data-driven machine. And what that means for you, the investor, is that the thesis is no longer about how good the burger is. It's about one thing and one thing only. Do you believe that this management team can actually pull off this incredibly difficult transformation? And that leads to the final multi-billion-dollar risk. Everything that made Shake Shack special, their entire brand, was built on this idea of a premium, almost personal experience. But every single change they're making to become more efficient, the cheaper buildings, the ordering kiosks, the focus on speed, every single one of those things chips away at that premium feeling. So the question becomes, can you turn the magic into an assembly line without killing what made it magic in the first place?
Can they get cheaper and faster and still convince you to pay a premium price for their food? Because let me tell you, if that premium halo disappears, if they lose that special status, they're not special anymore. They're just another burger joint in a very, very crowded market. And if that happens, this whole fortress the analyst is talking about, it comes tumbling down. So we land right back where we started, but now you have the full picture. On one hand, the evidence is clear. This is a company that is actively and intelligently reinforcing its business from the inside out. The multi-million-dollar question is whether all that work, all those reinforcements, will be enough to handle the economic storm that's brewing on the outside. So is Shake Shack really forging a new, stronger financial fortress, built to last for decades? Or are they just frantically patching up the walls of an old building right before it faces the biggest test of its life? We've laid out all the data. The decision, as always, is yours. Thanks for joining us at Iron Financial, where we cut through the weakness to help you build strength.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.